Simple strategic planning and financial modeling. This template will help you to develop a simple strategic plan and carry out financial modeling and financial planning. So this lecture is made directly with the Excel file available for download. And we are now on the title, but you can start working on a clean sheet here. So here you have the whole template with nothing inside. And I will explain you how these things works through an example. I think it will be more simple. So what we do, we actually mix strategic planning and financial planning together. And the reason why is because some measures from your strategic planning will actually influence your financial planning. And sometimes some of your financial planning element might also be part of your strategic plan. So that's why we are putting both on the same sheet. So what we do, we start with the measure of success. So you can put here all your measure of success. You can describe them if necessary, and you can also plan for 3 years. Year 1, 2, 3. So I only put here the amount of members. So you could put the other one, but just for the sake of this example, I only put the amount of member. In the strategic plan, same thing. You have the critical success factor. You can put all of them here. You can put the KPIs that explain them, and then you can plan monthly, month by month and year by year. So here again, I put the membership because it's also one of our critical success factor, and the key performance indicators is the amount of member. How many members do we have in our club, in our studio every month? So what we did, we have an incremental amount of member of 30 every month. So we start with 0, then we get 30, 60, 90, 120, 150, and so forth, to reach eventually 1050. Make also sure that if you have the same measurement in the measure of success and the KPIs, key performance indicators, make sure that your month 12 is the same as year 1, 330, 330, okay? Same thing with year 2 and month 24, and year 3 and month 36, okay? So now that you have your strategic planning, you can look at your financials. And in your financials, the first thing we can look at is incomes. Okay. I'm not trying here to give you an accounting lessons, and the things I will show you are not 100% orthodox, okay? But the idea is just to understand the financial requirement of your project. It's not to become an accountant here, okay? So that's why I call these incomes, for example, and I don't call it sales because it might mean something else, So let's make it simple. So here in the incomes, what we'll get, we'll have membership. And the membership, the price per unit will be 650. So what we will do, we take this number times multiply it by the amount of members we have on this month, meaning 0. So 650 times 0 is 0. Then after, for month 2, it's the same, 650 times 30 this times, and we have 19,500, and so forth, month by month. What you can do is you block your case, this one, you block it, and you make times the 12, this one, and then you can stretch your formula. So if you are not used to Excel, that's a way to do it simple. If not, you will have to write 36 times the same formula, which is pretty stupid. Then so here in the membership, basically what you can see is like when we sell, so when we get the membership, we get the money as well. Sometimes this doesn't happen. You will sell on month 2 and then you will receive the money on month 4, for example. But we don't really care about that. If this is the case, just count when the money is in your bank account. Okay, only count the realized sales. Okay. Then when this is done, you can look at your startup cost. And in your startup cost, in our case, what we'll put there is the renovation of the facility, the material, the incorporation cost, and the opening. The amount here are in Hong Kong dollars. So if you find, oh, that's pretty expensive, it's because I'm counting in Hong Kong dollars. But we don't really care. It's just a number we need here. So you might have a more startup cost. If this is your case, you can actually insert a new row. you see, and you can introduce your new cost. Then what we do with that is like basically a startup cost most of the time will be on an asset, and this asset you will use it for a couple of years. So what we do will spread the amount of money here, like the 500,000, on the entire lifespan of your asset. So the renovation, we can say, oh, we can keep it for like 5 years. So these 500,000 will divide it by 5 years, and then what we'll do, we'll divide it by 12 months. So that we get a monthly, how much this renovation will cost us monthly over the lifespan of this investment, of this asset. So we will have a monthly depreciation here, 8,333. And then what we can do is to input this amount month by month, and this will help us to calculate the break-even. That's why I'm doing that. You do the same for the material, because material you can use it also for 5 years. So you see in the formula we have the initial amounts divided by 5 years divided by 12 for the month, and then again you put them here, and you do as before, you take it and you stretch the formula like that. Okay, good. Then after that you have the incorporation and opening. So it's also a startup cost, but I didn't really depreciate it because it's kind of small amount. I just account it straight away on the first month. Okay, so we have the opening will be a kind of small ceremony for people to come and drink or a cocktail or something like that, and we'll put everything on the same month, 2050. So what we have here, we have a total startup cost per month, and we have also the total startup cost here of 1,570,000 Hong Kong dollars here. Okay, so here we are. Now we move to the next type of cost. We'll look at the fixed cost, and in the fixed cost, what you will put there, you will have your rent, your marketing, the salaries, the electricity, the water, the insurance, and then this will be the monthly cost of each of these items. So you see we have a total of 132,000 Hong Kong dollars fixed cost per month. So what you do again, you input all these data here in each of the months. So you see it's exactly the same, 50, 50, 10, here, 10, 10, and then you spread the whole things over the 36 months. Then here you will have the sum of all these, and you have a total fixed cost per month of 132,000, which is actually the same as here, and that makes perfect sense, so it's good. Now we move to the variable cost. Well, for a fitness center, you don't have much variable costs. Mainly you have a startup cost with a big investment at the beginning, and you will have a fixed cost. Your electricity and water could be in a way included in variable cost, but at your stage it will be almost impossible to know how much water and electricity you will use per member. So what we do, we just put a quota and we put it here. So on variable cost, for the sake of this example, I just say that we will distribute towel to the members, and each towel will cost us $5 per month per member. Sorry, each member will cost us $5 off towel per month. Okay, that's an estimation. And then we have a total variable cost here of 5, and what we do, same as for the income, these costs will variate, will be different according to the amount of member we have in the facility. So what we do, we take $5 times in month 1 0, month 2 30, month 3 60. So you can see here 0 times 30 is 0, 5 times 0 is 0, 5 times 30 is 150, and 5 times 60 is 300, and so forth. So we have a total variable cost here, which is the sum of all the variable cost. As we have only one, it's basically the sum of itself. But I still put the formula because if you have many variable costs, it will be useful for you. Then we have a total cost. And what will be the total cost? It will be basically the sum of your startup cost monthly, the total of your fixed cost monthly, and the total of your variable cost monthly. Okay. Then now we have a total cost, and you will look month by month, how much is that, you know? Here we see that month 1 we have more because of the opening and the incorporation. It's 227, one after is 157,000 more or less. Then after, you can look at your results, and the results, what you will do, you take your incomes minus your total cost, and that you get your results. When it's negative, it's a loss. When it's positive, it's a profit. So what it tells us here is that we will be basically losing money month after month for 10 months. Then on the month number 10, we actually reach the break-even finally, and we start making money. So we get here 17,150 Hong Kong dollars profit, and from there we are profitable until the end of the project. And we can see that potentially we can make around 500,000 Hong Kong dollars a month profit with this project. So another thing we can look at is the cash. Like, profitable is not a problem. I mean, it's a problem for sure, but it's sometimes not why the business are doing bad. Most of the time they lack cash. So what we look at here is the cash. Initially, how much cash do you need to start up this project? And then this will be like the sum of all your equity, debts, and so on. Okay, equities and liabilities. 3 million to start, let's say. But the thing is that as soon as you receive the money, you have to make an investment, and this investment is this one here, 1,570,000. So basically your cash will drop to 1,430,000 because it's 3 million minus your initial investment. Okay, so here we are. After investment, we have 1,430,000. So what we do with this cash afterwards is that every month we'll add the results to this cash. So here we see that the cash is actually going down because we have made a loss. So we do here this cash, sorry, B61, so the cash after investment, plus D56, yeah, which is the result on month 1. It's a loss, so basically we have less money here. And then you'll say, but hey, what's this D39 that you are adding? Well, what I did, I actually add the startup cost monthly. I added to the cash. The reason why is because we already pay before starting, so we won't count it twice. You see here the initial, we had an initial cash of 3 million, and I took away already the startup cost. So if we use these results, it's actually include once more the startup cost, and we don't want that. We want to take it away. So basically I add the startup cost to make sure that we only deduct the startup cost once and not twice. Okay, so we do that month after month, and what you realize is that the minimum level of cash we will get with this venture will be on month 7. And it will be 912,350 Hong Kong dollars. And will tell me, but why we reach the minimum on month 7 instead of month 8, for example? Because I mean, we reached the on month 9 because we reached the break even on month 10. Well, the reason is because I put back the monthly startup cost. So that's why we reach this minimum a bit earlier. Yes. So what else can we look at is the cash requirement. So as we know that on month 7 we'll reach our minimum, so how much money we need to finance this initial period where we lose money? And we realize that we need 517,650. It's basically B61. Here we are, minus minus G60. Here we are. That's basically the initial cash requirement, plus for sure your investment. So that's the cash you need. The rest is for safety. And for safety, how much you have? Well, basically is 912. Now you have to think and ask yourself the question, is it too much money as a safety, or is it not enough, or whatever? Depending on your venture, you can estimate that. It will also depend on your risks. Because this is planning. For sure it all looks great, but when things will happen, this will most likely not happen the way you plan it. So you need safety anyway, but you have to think, is it the right amount, or do you need more or less? Then another thing you could look at is we have here a break even for, like, when do we reach the break even. But what you can look as well is like how many members you need to reach the break even per month. And what you realize is that you need 237 members per month. And how we calculate that? We take our, this is the formula. So we take our fixed cost. Let me put it big for you. We take our fixed cost divided by the price per unit minus the variable cost. And this is what we get, 237 members. So you can see here the FC is fixed cost, P is price, VC is variable cost. In the fixed cost, what I do as well, you can see from the formula, I have here the fixed cost, B47, and I also add the monthly startup cost to calculate the break-even, because it's actually assimilated to a fixed cost, as we have to, basically we are accounting it every month. So here we are, we have a monthly break-even of 237 members. And you can see your cash evolution here. Is that at the beginning you will lose a lot of money from your 3 million, boof, you get to almost like 1 million something. And then you go down to the minimum level in month 7, and then from month 10 you are reaching your break-even, and boof, you start making money months after months. And basically here you are done with your financial modeling. You have everything you need. Yeah. So what you can do is you can select each of the different elements here, such as your price per unit, your variable cost, your total investment, your fixed cost, your break-even, your minimum cost here. You reach break-even in month 10. Yeah, so you can actually put all these things together and add it to your financial part of this first draft of business plan.